Welcome to Beyond the Flight Deck podcast with United Airlines pilot and investment advisor Alan Bewley, who will take you behind the scenes with airline pilot entrepreneurs, academics, and other professionals. And now, your host, Alan Bewley.
Stock picking has been a phenomenon for hundreds of years. Unfortunately, few investment professionals and even fewer individuals can outpick a market consistently over the long run. This spawned a new investment style in the 1970s called indexing, where you purchase an investment product that tracks a given index. The biggest benefits are diversification and low cost. While index investing is proving superior to active management, there's an abundance of academic research showing its shortcomings. Kevin Green is head of investment solution analytics at Dimensional Fund Advisors. His career began at a hedge fund, but he quickly realized there was more to investing than speculation. Kevin went back to school and got his PhD from UT Dallas, where he studied returns of initial public offerings, or IPOs. This research background fit perfectly at Dimensional, where 5 members of the investment committee are Nobel laureates. Kevin and I discussed evidence-based investing, an academic-rooted alternative to active management and indexing. Now, while we have no financial relationship with Dimensional here at United Wealth Management, we do use a selection of their ETFs for ourselves, our families, and our clients. Welcome Beyond the Flight Deck. Kevin Green, PhD, Dimensional Funds Advisors. Welcome Beyond the Flight Deck. Great to have you.
A pleasure to be here, Alan.
So we talked a little bit about you in the introduction, gave a quick bio on you, but let's dive a little bit deeper, as I like to do on this podcast, get to know who you are. So quick and dirty on Kevin Green's background. Where'd you grow up? Maybe what your parents did for a living? You know, what was like growing up in the Green household?
Yeah, Alan. So I grew up, so unlike many here at Dimensional, despite being located in the state of Texas, I am a native Texan. Grew up in a small town in East Texas, Huntsville, Texas. If any of the audience viewers know, it's not known for a ton, but there is a small university there, Sam Houston State University, and that kind of is where my parents were employed throughout my youth. And so that kind of, for me, motivated my interest in ultimate pursuits and kind of the academic form of the world. But Huntsville was a great place to grow up in. A small town, youth sports and everything that comes with that. A nice building block for ultimately where I am today, and a nice place to be a part of.
Yeah, very cool. Yeah, for those that don't know, Dimensional based in Austin. They've got offices in Charlotte and out in California, London, but their main headquarters there in Austin, which we've visited a few times. Oddly enough, our CEO, Scott Kirby of United Airlines, is also from a small town in Texas. I forgot the name of it, but he's another small town Texas kid, just like you. So, all right, so all your friends in high school, were they like, yeah, Kevin's going to go on to school a whole bunch? What were you, if there was anything in your high school yearbook, is Kevin was most likely to what?
Yeah, good question. So I don't think that many thought that I would go on to be in school for as long as I did. I was fairly well-rounded at the high school. I played sports, but one thing that did stand out is an interest in the stock market and investing. So starting in junior high, I kind of had an interest in it, and then throughout high school, whether it be jobs working at Wendy's fast food or mowing jobs, I accumulated some money through that, and I started to invest it. And while my friends were interested in many of the things that, your typical high schooler is, and I was as well, but I also had this budding interest in investing that kind of set me apart from a lot of things that my friends were interested in. So while I don't know that they would have said, Kevin's destined to stay in school and earn his PhD, I think especially my close personal friends knew that investing and ultimately working in that career path was something that I was keenly interested in, and something that eventually turned out to be an accurate portrayal of who I was.
Yeah. My dad and I on Sundays would sometimes go to the library in Birmingham and look at Value Line, because that's where it was available. And we talked income statements and balance sheets, because that's where you could see those in the Value Line newspaper or whatever. So yeah, you and I had that in common. So, but for me, it didn't come back around till I was in my early 30s when I got into investing after 9/11. So Interesting. All right. So in the intro, we talked about your undergraduate, your master's work, but let's talk for a couple of minutes about your PhD work at UT Dallas. Talk to us a little bit about what you did there.
Yeah, well, and I think as a part of that, it's probably good to step just one step before entering my PhD. And I started out my career working for a hedge fund in the DFW area. Q Investments is the name of the fund, and wonderful experience. Real, introduction into capital markets. It was a multi-strategy fund, able to invest in any type of, strategy you can imagine as you see fit. But through that, I realized that there was still a part of me that wanted to go back, a yearning to have a more rigorous approach to thinking about investments and how to make an analysis. And that academic curiosity is something that ultimately pushed me to step away from that career path and go back to school to pursue my PhD at UT Dallas. Now, as you can imagine, a lot of that kind of hedge fund practitioner experience really kind of informed what I was interested in from a research standpoint. And one of the things that always stood out to me is some of these, what many think of as maybe an arbitrage situation where there's an opportunity to make a quick profit from the market. And IPOs was one of those topics that I routinely heard about. And I was curious about evaluating kind of what that looked like in a more rigorous and data-based approach.
Okay. So tell me a little bit about, you dove into looking at IPOs. Did you, I mean, so what was the thesis? What did you come away with? Did you come away with IPO returns? Did you come away with, what was the big picture for us non-PhDs of the world?
Yeah, Alan. So, what a lot of times people think about IPOs is that spectacular return on day one when those shares hit the secondary market for the first time. And think that forces a lot of people or gives the impression for a lot of folks that IPOs are a very attractive investment opportunity. And having the opportunity to put money to work in an IPO is a way to really turn a profitable investment. What the research data shows is that IPOs, outside of that one-day spectacular first-day trading, they tend to not do so well. Generally, there's Jay Ritter is a longstanding academic that's done a lot of research on IPOs, and what he's found and what's been replicated many times over in the academic literature is that IPOs tend to do fairly poorly, in particular that first 1 year horizon or so after they've gone public, excluding again that first day. Okay. So I was looking at that, and one of the things that I was particularly interested in is there's an event around IPOs that they call the lockup expiration. And so when these companies go public for the first time, as a part of their efforts to sell these shares to the market, the insiders that typically hold a majority of the shares being sold are restricted from selling those shares up to a period of 6 to commonly 12 months. And what you see is that when those shares are available, finally made available to sell, it's usually a very large liquidation event. Right? And you can think about this. Some private equity firm has invested in this company, and this is their exit strategy. And now they're finally able to redeem those shares that they've been holding on to. And what you see is that the amount of shares being traded tends to spike around these expiration events. And what happens is markets, the stock price of those IPOs tends to fall or decline as a result of this expiration event. So that's really where I was focused on is this idea of, is there a way to profit from this information? Is this something that the market's not aware of, that there's this liquidation event looming? And despite the fact that you do see poor performance around this, what I was able to really dive into is once you get down to the microstructure aspect of what's happening is really that effect is driven by some very small IPOs that are very illiquid, and trying to put together an actual trading strategy with dollars at work, you're pretty constrained in terms of the amount of capital that you could put to work and potentially gain a benefit from that. So what it really did for me is this storyline of, oh, maybe there's a market inefficiency there or something that's not getting priced in. And what all my work told me was that, no, the market's actually doing a pretty good job. And any attempt to try and profit from this is laden with risk in the form of not being able to buy those shares or be able to sell them in the speed at which you would need to routinely or robustly earn a profit in those situations. So for me, it was a nice kind of reaffirmation of this idea that, the prices are being fairly reflected in the marketplace, and trying to pinpoint a specific outcome where you can make a free buck, if you will, is pretty rare
Yeah.
and often not something that you can put a lot of money at work at.
Sure. Do the company founders that are still around for these IPOs, do they usually liquidate some shares at those point as well, or is it mostly institutional investors? Is it everything?
It can be a combination. Now, once you get to founders and those types of insiders, they're usually beholden to a sharper set of rules in terms of when they can sell, how much they can sell because of their continued inside information. Whereas oftentimes some of the institutional investors, they're no longer a part of the day-to-day business operations. And so quite commonly you see more active selling from those individuals
Sure.
as opposed to kind of the founder of the company that remains
Yeah.
as a part of the day-to-day
Sure.
operations.
Sure. Yeah, you'd run into SEC problems if they start dumping. Yeah. Um, so does the data tell you, hey, just avoid these for the first year, or it's got to be deal, IPO specific, I assume, but if you could avoid them for a year before what? You get company financials that are released and really understand what the company looks like. Is that kind of what it points to?
Yeah, Alan. So my work was specific to the expiration, but if we take a broader snapshot of IPOs, what you're relating to there is that exactly what we see from a data standpoint. Is that you see these companies go to market and they may have a spectacular first day.
Mhm.
Question is, how accessible is that to the everyday investor being able
Right.
to participate in those IPOs and know which ones are going to have those spectacular returns? And then from there, what we see um, is that they tend to underperform generally around up to 1 year relative to the market. Now, in combination with that, what we also see, and we'll get into this later,
Yeah.
the characteristics of these IPOs. They tend to have very high valuations. In other words, they look very growthy.
Yeah.
And more commonly, they also tend to have pretty poor profitability
Yep.
characteristics.
Okay.
So not only do we see some of these frictions from just a market operation standpoint, these stocks also have kind of the characteristics, and we'll talk about it again later,
Yeah.
of stocks that tend to underperform the market on average.
Right.
And that's indeed what you see whenever you form kind of portfolios of these new IPOs and you look at kind of what their characteristics are, you find they are generally
Yeah.
low profitability growth stocks. And when you run that through kind of an asset pricing test, you see that they load up on those kind of
Right.
factor returns. In other words, they move just like those groups. And so when we put all of that together, it kind of makes sense of these are not stocks that you necessarily want to hold in your portfolio
Yeah.
because of what we observed empirically in the data. And as a result of that, I think as I was going through kind of my interview process at Dimensional, relating my research, and it just went hand in hand with kind of the policies in place at Dimensional, in which we're not going to add one of these IPOs to the portfolio until at least 12 months has passed
Right.
post the initial public offering. And that's really designed to alleviate the exposure to kind of this underperformance of,
Okay.
what we see on average is robust. What's the motivation to hold them? Well, there's not a great draw
It's
there.
cool. It's cool. Yeah. So from the individual investor standpoint, oh, there's this IPO of this great company I'm hearing about that does really cool stuff. So let's invest on it. And we're able to just jump in and, okay, the market's open. I can grab it. Well, it's probably already had its great day the second the market opens, right? So, and then they hold it, and little do they know that over the next 12 to longer months, it may well underperform their expectations, whatever those are, the market. So as opposed to an approach where through empirical data, you collect evidence and make your investment decisions based on that academic research versus, hey, this looks kind of cool. This company.
Yeah, that looked kind of cool. I think that's really kind of the takeaway there. Of, if you look at something like the Russell set of indices, I think in part trying to gain some attraction from this idea that IPOs do really well, they'll do interim rebalances throughout the year and pick up all of the new IPOs since the prior rebalance as a way to kind of highlight to those investors that are tracking the indices of, hey, you're getting access to this new set of firms in your portfolio. And what's interesting is if you compare the performance of those IPOs that they added up until that 1 year mark, and you look at the average monthly performance of those stocks versus the overall Russell index, well, as you can imagine, you see positive returns on average for the Russell Index. You see negative returns on average for those stocks that they're trying to rush to add as a kind of a way to attract those investors that think that this is a sensible investment. So not only do you see it kind of in the academic world, but you look at something from a practitioner standpoint and just look at an index that's looking to add these IPOs, and you see that they underperform on average by a wide margin post addition to those indices.
And they're buying it simply because those firms now entered the index, not because there's an academic reason for owning this firm.
Well, yeah, but even more so than that, because they do these special kind of rebalance. And
Oh yeah.
typically you think of the Russell indices of rebalancing kind of once a year to capture all these new stocks. Well, for these IPOs, they'll do interim to make sure they're adding them as they would put it in a timely manner.
Yeah.
Which is exactly the opposite of how we would want to look at them, as you're going to wait and be patient as opposed to rush to gain access to something that has underperformed. And certainly we expect to continue to be that way.
Okay, so strike one for index investing, right? Strike one. Okay, interesting. All right, let's change gears just a little bit. You mentioned about your research and how it played a role even in your interview at Dimensional, because Dimensional is definitely, with 5 Nobel Prize winners on our investment committee, most definitely an academic-driven research investment company. Give us the quick and dirty background on DFA, Dimensional Fund Advisors, and kind of how we got to where they are today, 23 years or 43 years later, sorry.
Yeah, Alan, I'd love to. And actually, this is something that I get really excited about, thinking about the history. And the reason that I get excited is it's really impossible to separate the history of Dimensional and our investment philosophy and kind of the evolution of financial science and how we think about investing and how the academic side of that evaluation has grown. So you think back starting, to the 50s and 60s, going back that far, there was kind of this hotbed of new ideas and thought coming out of the University of Chicago, as well as MIT, and thinking about how historically investing had been largely an active approach where you have stock pickers trying to say, this stock's either under or overvalued, and I believe I'm going to outperform based on XYZ information. Right. And what was limited was a lot of data to really test and understand whether or not there was an accurate assessment of those kind of that thought idea. And so in the 50s and 60s, you saw a boom in both kind of the computation technology through the use of computers and also the availability of historical data to actually put some of these things to work and test and evaluate whether or not there was something there. So some of the big takeaways from that were this idea that, diversification matters and you can alleviate a lot of the riskiness of your portfolio by having a broadly held basket of securities. Also, there were some models around how to think about this risk-return trade-off, a capital asset pricing model. I'm sure many of your viewers have some familiarity with of kind of this systematic risk, this non-diversifiable risk as a way to project what the stocks in your portfolio would generate return. The important takeaway there being that it's more of thinking about the impact to the portfolio risk as opposed to looking at the individual risk of those securities. So all of those ideas and concepts were coming into play. And as they started getting tested, there's this whole broader idea of market efficiency.
Right.
And that really think back to Eugene Fama, and many describe certainly myself as kind of being the father figure of modern finance, and this idea of markets being efficient, which is to say that the prices we observe today, are fair reflection of what to expect going forward, meaning there's not a better way to kind of take what the market is telling us and make a judgment call as to whether or not there might be a way to outguess what we see in market prices. And that's really what he set the table for. And you think about the starting point of Dimensional, David Booth, prior to starting Dimensional, he worked with Mac McCown, and they developed some of the first index tracking funds of their time. Now, they had some, versus what we see today, they had some major construction flaws in terms of being kind of an equal weighted approach as opposed to a market cap weighted approach. And
but let me jump in real quick though. Matt's work, if I'm correct, was actually prior to Bogle's work. That he did it at Wells Fargo, or I think it was, and then they just handed it to Mac and said, here, you're crazy, you can go do this. But this was even before Bogle started Vanguard.
Yeah, you're absolutely right. So he was there at Wells Fargo, and he actually hired David Booth to join him and kind of working together, put together the first, prior to Bogle, the first index fund as a part of their partnership with Wells Fargo. So that was really, think about the motivation for that, really driven by this academic insight to prices being fair. And if prices are fair, well, you want to move away from kind of this active stock picking approach and into something that gives you market-wide exposure, broadly diversification, without trying to outguess market prices. And so that was an interesting kind of starting point for thinking about dimensional and where our roots are in this kind of belief in indexing and the value of having a sensible, low cost, broadly diversified approach.
Right. When you think about indexing versus active stock picking, talk to me a second about active stock picking on an individual level, where I'm just sitting at my computer today with free equity trades, and also then an active fund manager. Why that is basically going out and spending a ton of money on research on all these companies. Why do they both, the individual investor staring at their computer trading for free on, whatever website, E-Trade, Schwab, and also the active stock picking fund manager? Why have they struggled? I think the active manager data now is over any given 20-year period, about 15% actually outperform their benchmark after fees, expenses, and trading costs, something like that. So why are they both struggling to outpick the market?
Yeah, I think, Alan, you maybe comparing kind of the retail investor investing from home, trying to guess which stocks versus maybe what many might assume is this very knowledgeable, well-researched, active manager, both attempting to do the same thing as look at prices and decide where they can invest and ultimately beat the market. And I think for both of them, maybe it's, they both face the same promise of they are one of many, many, many investors that are trading every day. And I like the word trading because you think about these are not people sitting on the sidelines making a forecast as to what's going to happen. They're actually putting dollars at work. And when somebody's putting dollars at work, you can bet that they're making an informed decision as to what the expected outcome are for a given investment. And so you think about whether it's an individual or a well-informed active manager, they're trying to outguess the information set of thousands and thousands, if not millions of investors that are doing the same thing every single day. And the idea that on average, and being able to do something accurately over a long periods of time, that's a very challenging proposition to assume or expect that someone can do that routinely and be successful in trying to take information, a subset of information beyond what everyone else can see, and make a decision that puts them one step ahead of the overall market.
Right. The market, which is an information processing machine, right? I think the last I saw, $750 billion worth of equity trading volume a day or something like that. So if you're trying to pick a security you think has a higher expected return than some other, that's what you're guessing against. It's $750 billion a day in equity volume. So,
Yeah.
yeah.
Alan, one thing to think about, I don't know if you're a sports fan, but you think about, we have college football season upon us, and you have these, top ranked teams playing, some smaller schools as a part of that. And I think for most of us, it's pretty easy to pick who would win the contest. But as soon as you start to take all of that information and think about, oh, well, there's a spread on this game that the market can see and says, oh, we expect this team to win by X amount. Now trying to outguess that is somewhat akin to thinking about the market of all that information is being reflected. Everybody else is seeing the same things you are. So trying to suggest that you can be one step ahead of that is a very, again, challenging proposition.
Okay. Well, you're happy because Texas won this weekend, right? And I'm very unhappy because Auburn just is not good this year. Sorry to any Auburn grads out there. It's just bad right now. So you just turned this whole interview backwards there, Kevin.
Sorry about that. Didn't mean to touch on a sensitive subject.
Yes, we did. Yes, we did. It's hard to be an Auburn Tiger sometimes. Anyway, all right. So let's go dive back a little bit into DFA. I'm not sure where we left off there. I steered you off a little bit, but working off the academic research of now numerous Nobel Prize laureates, which is very cool. So we talked a little bit about active versus, say, the individual, why it's so hard. What's interesting, I saw several years ago, and I can't remember who got them to admit it, but Morningstar in a private conversation finally admitted that their 5-star rating program on mutual fund managers basically was bunk. They basically said, if you just go out and find the lowest cost manager, you have the highest opportunity of potentially outperforming or at least getting market returns. because the other managers face such high cost, not only their explicit and implicit costs, right? Their outright fees to their internal cost of doing things and whatnot. So
Yeah, Alan, I think, that doesn't surprise me. And we see the same thing, right? So a lot of the ratings and whatnot, there's certainly a quality of kind of the management infrastructure, but also if you're going to do a proper job, performance has to play a big role in how you rate a particular fund. And so interesting enough, we do a study every year. We don't put star ratings, but we do a study
yeah,
every year where we look at the performance of active management. And you referenced it earlier, but one of the things that we do is we say, for all of those managers that have done really well, let's look at what they do in subsequent periods
right,
relative to their
right,
peers. And so interesting, what we find there is that for those managers that do really well, and we'll call it those that perform in the top quintile of firms or funds, how do they perform in that subsequent period? And what we find is that, if you put a random chance of probability alone, that there's a 1 in 5 chance that those managers remain in that top bucket. And what we find on average, that's right about what we see. One in
yeah,
5
1 in 5.
of those that outperformed previously remain in that top bucket in subsequent periods. And that's right exactly what we would expect if we were to just choose any fund manager at random as to what the prospects are of them outperforming going forward. And so what that's to suggest is that while it's not a star rating, you look at something like performance, and it's hard to distinguish what is luck in terms of the
Right.
outcomes versus what is true skill. And even if someone, maybe you could really refine and say they had skill in a prior period, what's the likelihood that that particular set of skill and knowledge is going to be persistent going forward? And it's just a very challenging thing to do, and just a downside of using something like performance to evaluate an active manager, which I think lines up exactly with kind of what Morningstar's broader takeaway is. You
Yeah.
can't just look at an analyst rating and use this to decide how's a relative performance going to look going forward, because oftentimes, those managers are going to perform. And in the case that we're describing, 80% are going to fall into the bucket outside of that top performing group. And in
Right.
fact, many of them are going to underperform just a passive approach.
Sure. Sure. And one thing, then you layer on the individual behavioral proclivities on top of that, where I look for a manager with the best performance history. I buy his fund, and then over the next 3 to 5 years, I find that they underperform. So I fire him, sell the fund, and then do it all over again with the next guy that had a good 3 to 5 years. So you add on the investor behavior on top of the fund performance and analytics or their lack of. It ends up for a poor investment experience for the
It
individual
really,
investor.
it really does. When you're looking at something at performance, it can be a key criteria that you want to consider. But certain things you want to avoid is you don't want to focus on a very narrow time horizon. You certainly don't want to focus on one specific strategy within a manager's broader
Mhm.
portfolio of products. So to try and alleviate some of the sensitivity around that, what you want to do is look over long time horizons, and you want to see if the outcomes that you observe are consistent across the many strategies that a manager employs.
Sure.
Don't want to find a one-trick pony who just happened to get lucky in a particular market. Is the investment process, or is their investment value add repeatable and something that you can bank on continuing going forward? So,
Yeah.
if you're going to be looking at returns, those are the kind of things you want to look at: consistent performance over long time horizons and consistent performance across the breadth
Across.
of the strategies being offered.
Okay. So that's our least favorite form of investing here at United Wealth Management. Our second favorite is indexing. We use a little of it here and there. Talk to us a little bit about index investing, say buying the S&P 500 or Russell 3000 or some Vanguard total market index fund, something like that, versus say the active approach. What are the main differences there?
Yeah, some key differences between indexing and active, and then the bucket I'll put dimensional one would be more like a systematic active, and I'll try to distinguish the three. So for indexing, let's first start with the benefits. Indexing has done a great job of providing broad diversification for investors at a low cost. So the ability to have access to thousands of securities in your portfolio at a cheap cost was something that prior to the advent of indexing was simply just not possible for individual investors to do. So from that standpoint, it's been a great boost to the ability of investors to participate in the market, and do so at a cost point that works well. Now, you push that against active, and well, let me say the objective of indexing, right? That's a a critical takeaway there. The objective is indexing, especially for trackers, is to deliver the performance of a particular index, and then net a fee. So deliver the performance of the particular index minus the cost of, of doing business. And so if you think about that from an investor's perspective, is the goal is not to outperform markets. It's simply to perform in line with what you observe in the marketplace minus the cost of paying a manager to provide that service for you. So that's the kind of broad diversification at low cost with the goal of kind of mirroring or tracking what the market does. Now, active is going to do a different approach where commonly they're quite more expensive than indexing, because the cost of trying to decide which stocks they believe are going to outperform or underperform is a little higher than simply trying to mirror the market. So you're going to be paying a higher fee. And then it goes back to this belief of, do I observe enough evidence to suggest that after fees, these managers can outperform the market? Now, by definition, right, if you look at all the active managers, collectively, they have to hold the market in aggregate.
Right.
So just based on expectation alone, we know that if on average they hold the market, then after fees, we should expect on average, right, these guys are going to underperform the market net of fees. That's simply just the arithmetic of active management. Now, what we find, which is what's interesting, is that these guys actually perform worse than what you would expect by random chance alone. So on expectation, we expect these guys to on average underperform. And what we see in reality is that they tend to perform actually worse than what we would expect by random chance alone.
Sure.
Now,
which is why I think individual investors and advisors are moving steadily away from the active managers and towards indexing, or better yet, evidence-based investing. I think you guys are seeing that as well.
Yeah, we see the same thing. A lot of shift from traditional active into indexing, and then obviously where we come into play is kind of going beyond indexing, providing that same service of being able to offer broad diversification at a competitive price point. But the difference that in our approach is we're not simply looking to replicate the market performance. We're looking to use the insights, the information that we observe in prices to actually outperform the rate of return delivered by the market. So that's where that active approach comes in, of not just sitting on the sidelines trying to replicate the market, but indeed trying to actively put ourselves in position to outperform. Now, the interesting thing is it's not an attempt to outguess market prices of saying this price is right or wrong, but it's rather an attempt to believe that the market is doing a good job of pricing and using our approach to identify those segments of the market that we are observing have higher expected returns, and putting a higher degree of emphasis on those segments of the market and a lower degree of emphasis and underweight on those segments of the market that, from what we observe, have lower expected returns. And in doing so, we're able to provide a product that does offer broad diversification at a competitive price point, but has an expectation that it's going to deliver outperformance relative to the target market.
Okay, so in general, let's say you're buying a U.S. equity fund through Dimensional versus, say, Vanguard. The Vanguard fund holds a market cap weighted portfolio typically. Basically, what, 70% of your money is in the top third companies by size, split evenly between companies with higher relative prices or maybe lower relative prices. So just a market cap weighted approach based on however big the fund is. So right now, NVIDIA, Apple, if you own an index fund that's US market, those are by far your largest holdings just because of their size, basically. And then all the small companies down on the bottom that you've never heard of, you're talking a third of your money in the bottom half or 70% even of the US market. It's a low cost, fairly efficient way to do things. So what is evidence-based investing from that standpoint? How do they differentiate themselves? You alluded to it a minute ago, underweighting certain types of equities that show certain types of returns. We're not talking names. So kind of walk us through the quick and dirty of how does Dimensional, how is evidence-based investing put together a portfolio a little bit differently than an index fund?
Yeah, that's a good question. So, Alan, the evidence-based investing, again, it's not on an individual name basis, but rather looking at the characteristics of stocks across the market, looking at characteristics such as the company size, whether it's a small cap or large cap stock, looking at the relative price, whether it's a growth stock with high high valuations, or what we call a value stock with lower valuations, and then also whether or not those stocks are offering high relative profitability characteristics compared to their peers. And we're going to use those characteristics to sort firms based on their expected rate of return. And the data that we observe shows that small caps outperform large caps, value stocks outperform growth stocks, and those stocks with high profitability characteristics outperform those with low profitability characteristics. That's, again, data going back, in some cases, over a century, both in the U.S. and outside the U.S. And we're using all of that to kind of inform of which segments of the market have those higher expected returns. And so you take something like a Vanguard fund that uses a market cap weighted approach, we're going to follow a similar approach as kind of our starting point of look at what those market cap weights are and use that to kind of form our basic portfolio design of how much weight we're going to put on each security. And once we start with that, we're then going to look at those characteristics. And if you think about kind of an ice tray approach, we're gonna start with the water being flat in that ice tray. We can relate because we remember having ice trays and putting them in the
We're old
freezer.
enough.
Yes, rather than pushing a button. But you think about that being flat and evenly distributed across those trays. You can kind of think of that as being the Vanguard approach, if you will, of just having an allocation based on market caps. And then what we're going to do is we're going to kind of tilt that such that we start to put more weight in those areas of the market, such as small caps, value, or high profitability. And as a result, we're going to take away some of the allocation from the large cap names, the growthier names, and those with lower relative profitability. The idea is that we have this broadly diversified portfolio that's rooted in market capitalization weights at the start, but tilted in areas that put the odds in our favor of being able to outperform the market going forward.
Over a longer period of time.
Yes.
Yeah. And so you still own everything that is in the Vanguard index fund, or you still own everything that's in an S&P 500 index fund, well, better yet, like a Russell 3000 fund. Just the weighting's a little bit different towards higher expected returns, not based on guessing companies, but looking at their characteristics. And this falls back on the work that Dr. Fama and the other academics, now like yourself, have been doing at DFA for a long time. What does it look like? So you mentioned it earlier. You've got that. Well, I'll back up. You own those stocks except for those IPOs that have been sucked into the Vanguard fund, maybe at mid-year or something like that. So one thing that I've learned about index funds is that they have to reconstitute at least once a year because they own this market cap weighted fund, and over the year it can drift away from that market cap weighting based on equity pricing movements and whatnot. So every year they have to reconstitute, sell things that are maybe overweight, buy things that are underweight compared to the index. And there's a problem with market pricing on those days, right? So when when Vanguard has to sell a stock because it's overweight compared to the index, is it me or does the whole world not know that they got to sell that stock that day? And therefore the price they pay for it, not so good.
Yeah, Alan, that's the point we're trying to think about there is this idea of, there can be a hidden cost to what is deemed as a truly passive approach of, I'm not trying to outguess markets. And oftentimes there's this belief that means that I don't have to think of things as cost in terms of execution prices that I'm getting in the marketplace. But when you look at these reconstitution events, that's exactly a consideration that investors who are pursuing a passive strategy should take in mind, because what you described as, those index providers are signaling to the market, X name is going to be added to my index on X date. Well, what do you think whenever you have all of these millions or billions of dollars that are tracking that index, if they want to have a very low tracking error, which again is their goal, they're going to be forced to buy or sell given security at the same day, at the same time, to alleviate any potential that their portfolio performs differently than the underlying index. And when you see that happen, it's interesting. You see volume levels spike to 10 times their normal average. And when you look at kind of the aggregate pricing effect, what you tend to see is that names that are added to the index, the price starts to go up prior to the rebalance date and then subsequently declines. And then for names that are going to be removed from the index, the price starts to to decline prior to the rebalance and then subsequently recover. So if you think about it, if you're waiting for that event, you're paying a higher price than everyone else that's trading around that day.
Yep.
And if you're selling a security on that event, then you're selling it at a lower price than everyone else that's selling around that event. So it's a cost that can go unnoticed because the performance of the index tracker looks exactly like the index. But if you just look at the numbers, you can recognize that there's some trading costs there that kind of get swept under the rug, if you will, and something that we've tried to highlight to investors to be cognizant of. If you're just comparing on fee levels, you're missing some of the other costs associated with a passive approach.
Yeah. There's definitely a few more basis points that are knocked out of your return there above and beyond. All right, so we talked a little bit about why it's difficult to be an active stock picker, and again, we're glad to see. As fiduciary advisors, that most advisors are walking away from that towards at least index, more passive investing, which we like. But what every investor has to understand is that their lifetime return will be the market minus fees, expenses, and trading costs. Now, you alluded this earlier about active stock pickers seeking that alpha, seeking outperformance through security selection. The markets have delivered great returns. Like, why people think we have to go out and seek higher returns through investment selection, which we know is next to impossible to do it consistently. So, and with index investing has its flaws as well. Again, our second favorite way of investing, we do use a Vanguard fund here or there, things like that. But kind of our second. So let's drill down a little bit more of evidence-based investing and let's put it into practice just a little bit, kind of high level. And everybody's favorite right now in the last 15 years, right? The FANG stocks or the Magnificent Seven, all right? Kind of define what those are in that market space, how they're priced, and compare that to, or talk about, should we go just grab a bunch of QQQ, non-financial tech stocks, whatever, and just sit on it knowing, hey, it's had the last 15 years has been great. Should we just get rid of the rest of the world, the rest of the markets, and just own this? What say you, Mr. PhD?
Yeah, and this question I get all the time, and it's really a challenging one for a lot of investors to overcome because the performance of whether it's the FANG or Mag 7 has been so spectacular as of late that it draws a lot of eyeballs and a lot of curiosity of, should I put more emphasis on these names to deliver this type of outperformance going forward? And you talked about, 10, 15-year period here. And what you're really alluding to is kind of the performance of the broader set of, we'll call them large cap growth stocks, those really large names that comprise a big chunk of the overall market capitalization that have what we'll describe as growthy valuations. In other words, the price of that security relative to the fundamental kind of value of the firm, there's a wide valuation multiple associated with those names.
Very expensive.
Yeah, they're expensive. Yeah, exactly. Yeah. On a relative basis, they are expensive. And they've done really well. So a couple of things to think about there. Of one, while 10, 15 year may feel like a very long time period, it's important to maybe take a broader scope. And we don't have to go too far back in time to find a 10, 15, even plus 15-year period where the overall equity market underperformed risk-free T-bills. So we think about that, and no one here on this call is going to doubt that equities have higher expected returns than a risk-free T-bill. It's just a part of the investment proposition. I'm going to demand a higher rate of return because of the risk. Right. But if you go back to the late 60s to the early 80s, there was a 15-plus time period there in the U.S. market where equities underperformed T-bills. Now, you take that observation and you think, am I going to forecast that going forward? Do I say, oh, I no longer believe that equities should outperform T-bills? No, you don't. And the right takeaway there is that you're demanding a premium from the market. And anytime you're demanding a premium, there's going to be this trade-off, and we'll call it volatility, where those outcomes are not always exactly in line with your expectations. And that can be such that, we have a year like 2022 where equities underperformed, or it can even result in longer time horizons in which performance is not in line with our expectations. It's simply a part of the investment experience that you will from time to time go through these periods. Now, going back to the equity pyramid, we can use that now as kind of a framework to analyze what's happened with these large growth stocks relative to kind of the small cap value stocks. And there, we've had a period of outperformance from those names relative to the small cap value market that we think has higher expected returns. But we just go back one more decade. So let's not look at the last, 15, 20. Let's go back to the lost decade in which the S&P 500, you can think of that as being kind of a proxy for these large growth names,
Right.
had a negative return over that period.
At
in
10 years.
comparison. Yeah, in comparison to positive returns for other segments of the US market, be it, the small cap segment or small cap value segment in particular. So we're really, to put it in perspective, we're talking about a fairly short horizon when we look at the broader picture, and we're trying to draw a story of, is this performance informative of what we should expect going forward? And so it has been outperformance from growth, but it's also been pretty strong performance from the other segments of the US market over that period. It's not as if small cap value or small cap stocks are doing poorly. They're actually performing. Yeah, they're actually performing pretty much in line with where they have historically. It's just been this subset of growth stocks that have done spectacularly well outside of what their historical rate of return has been. So I think about that and try to think about what that means going forward. To me, it's pretty challenging to say I'm going to ignore everything else that I see in the data and really focus in on this recent outcome to try and project what we should do. Now, the other part of that I want to make reference to is we talked about the Mag 7, and I think this is a really interesting anecdote for many market participants to consider as, while the names are different, right? A new set of names, 15 years ago, we weren't really talking about NVIDIA as being kind of a primary catalyst of moving the market forward. But this idea that there can be a subset of stocks that really drive outperformance and outperform the market by a wide margin is not anything new. In fact, you look back in time and you look at those names that have kind of risen to this upper echelon being the top stocks in the market. And what you find is that on average, those stocks actually do outperform by a really healthy margin. Right, leading up to that point, we see kind of double-digit outperformance from those names relative to the market, very consistent with what we've seen from these, Mag 7 names of really outperforming. Now, the interesting thing is, if you look at what happens from that point in which they reach kind of this top 10 names by market capitalization, you ask, how did those names then do subsequent to that relative to the market? And what you find is that, over short horizons, they perform kind of like the market, but once you extend out to 5 and 10-year horizons, those names actually on average tend to underperform the market, which I think kind of intuitively makes sense. You have this spectacular growth that people weren't expecting to happen. And, this financial performance, they've done really well. They've got up a lot of market share and they've been rewarded in the stock market. But you think about going forward, is that type of growth sustainable over the long term? And intuitively, the answer is no. And what we see in the data is that on average, those names just fail to continue to deliver that type of outperformance and perform either in line with the market or tend to underperform once you get out to a 5 and 10-year horizon. And I think that is really informative of folks trying to think about kind of the dynamics of what we've seen versus what we see historically, and then more granular of, is there something different about these names? And the names are different in terms of the company name, but the kind of outcomes that we observe are very consistent with what we see historically.
The story's the same. So going back to that late 60s to early 80s timeframe, even though equities underperform T-bills, what you might call a risk-less asset is kind of what they call it, or even in the early 2000s where U.S. S&P 500 equity returns were actually negative. Those are periods of time that that's the risk we take as evidence-based investors to capture that equity premium over T-bills over the long run. And so I loved it. You alluded to it a little while ago. In 1981 or 2, looking back 15 years, would we walk away from equities? Well, I always say one of the biggest demons to the individual investor is financial journalism. And Business Week in like 1982, frontline article, "The Death of Equities." Right? I was 10, but we still reference it all the time. And if anybody that remembers that article, God, hopefully people didn't read it and say, yep, good idea, let's walk away from equities and go buy T-bills, because the next 20 years would have been horrible. So the same with these Mag 7. We own them as evidence-based investors. They're part of our portfolios. In fact, NVIDIA, which you mentioned, that no one thought about in 2007 or 8 as this gigantic market mover, we've owned it the whole time. We will continue to own it because it's part of the market. But focusing on it is you have to be right twice. You have to be right before it starts its gigantic march forward and outperforms, and also when to underweight it you got to know then too, when it hits this high point where other large, huge companies have risen spectacularly and then just kind of reverted to the mean. I'll use that phrase, probably not correct academically, but so make it part of your portfolio, but it's kind of like timing the market. You got to be right twice. So you would have to know before this thing was going to take off and also when it's going to kind of fizzle out and mean revert. Is that
Yeah.
sum it
Yeah,
up?
you're right. I think if we go back to 2007 and you were to pick, what are the 20 names you think are really going to drive out performance going forward? NVIDIA probably wasn't in there, but I bet, some of the names you picked, maybe you could have picked a couple of them, but on average, right?
Yeah.
Most of those names are probably not the names that really outperform. So it's kind of revisionist theory of looking back and saying, oh, yeah, we could have identified these
Right.
names. There's no way to reliably do that and understand which of those names are going to propel. And so that's why it's important to have that broad exposure of, I'm going to have some exposure to those names, the ones that do really well. They're a part of my portfolio, but I'm not going to put all my eggs in one basket and try and
Right.
guess which of those names that I hold are going to be the ones
Sure.
that actually do that type of outperformance.
Fund wise, of course, QQQ is one of the hot ones now because it does own what, equally weighted X financials or something like that, top largest 100 companies or whatever. And people love about the past performance of that ETF or that fund, but they don't tend to go all the way back to when it began in the late 90s. That thing crashed spectacularly, I think 75% during the tech bubble burst. And so cherry picking data, right? Time horizons. If you take that one all the way back, it's not as spectacular as people would hope, but
Yeah, I think something like that, you have to be really focused on kind of the tracking error and the risk of you're going to have outcomes like you described where your performance looks quite different from the market and in the wrong direction.
yeah,
And you have to be thinking about that when you're trying to evaluate, is there a place for that in your portfolio? And for many of us, not only the drawbacks of indexing, but having that type of concentrated approach is not something that really resonates well with our investment approach.
sure. All right, so I'm going to try and sum this up in the way I tell clients very generically about evidence-based investing, and you fill in my blanks or correct me where I'm wrong. But we start with a market cap weighted approach, just like an index fund, but through empirical data, looking at research that's, I guess, been going on since the 50s or 60s, looking at data back a century. We simply want to underweight those types of companies that over that time period, say 100 years, have provided lower returns or lower expected returns in the market itself, slightly underweight those versus the market, to slightly overweight those types of companies, maybe smaller, you've mentioned, or value, lower relative price companies. We want to overweight those slightly versus the market. And why? Because that's where returns have come from, higher expected returns have come from over the last 100 years. Do we move around based on, do they change the weightings? In other words, is a portfolio built and then they just plug the names in over time, or do they change the metrics of what's underweighted and what's overweighted?
Yeah, that process is something that really benefits from a daily approach because, as you mentioned, prices change every day. So if you're waiting for once a year to kind of do a survey and figure out which stocks you want to hold, which stocks you want to over and underweight, you're going to have exposure to what we describe as nostalgia. If you're going to miss out on a lot of information in between the time that you updated versus prices moving every day. You think about kind of mowing your lawn. You can mow it once a year, but your neighbor's probably going to be upset in the interim. Something you kind of want to keep track of on a more routine basis. And that's something that we're doing in our portfolio. And it's not that we're having a large amount of turnover. Our turnover is going to be very consistent with what you would have from an index-based approach. It's just we're not waiting to execute all of that turnover in one day. We're just doing a little bit of turnover every single day to ensure that our portfolios are always properly positioned with where we want them to capture those higher expected returns. So again, low turnover, but something that's spread out across 250 trading days a year, as opposed to executing all of our trades in one day throughout the calendar year.
Very good. Well, what I love about being an advisor that has an evidence-based approach, I'm not trying to outsmart the market. I understand the limitations and costs associated with index investing. We have to be patient as evidence-based investors. Like you said, we tend to slightly overweight the types of companies that haven't done as well compared to the ones we underweight. The Mag 7 types company, which we own, they're our biggest holdings, but we just may not hold them quite at the market. Why? They're higher priced, they're huge, but they do tend to print cash, especially the Apples of the world. So, but there are other big names. But what's great about it being, I think, as an advisor that takes an evidence-based approach, we've been now for over 10 years, is that we can tell our clients over any given period of time why their portfolio did better than whatever their benchmark is, say the Russell 3000, or worse than, and why the worse than doesn't bother us at all, because as long as we're breathing for the next several years, we don't, we're happy. We win. If we're in this approach long enough, we win. But it's easily explainable. I'm not apologizing for bad stock picks that I made. That's what I love about it the most.
Yeah, the transparency is really critical to having alignment with understanding what our investment philosophy is, and then being able to look and see what we're doing in the portfolio and see that alignment and understand, looking at relative return outcomes, what drove performance in a way that is sensible and that you can understand and think about what those projected outcomes might be going forward. So, as you mentioned, one of the toughest things is to remain committed to a particular strategy when it faces headwinds. And by having transparency, by having the type of performance attributions available to clients, that's exactly the type of service we're providing. At some point, no matter what the investment philosophy, they're going to face challenges. They're going to deliver performance outcomes that are below expectations. But having the ability to understand what drove those outcomes and the confidence that it was a good decision, bad outcome, not a bad decision, bad outcome, but have that confidence is something that really allows you to stay committed to the strategy and capture those long-term outcomes, which is critical for any investment approach, is remaining invested over the long term. So I think that transparency, exactly what you're describing there, is one of the biggest benefits of our approach and our value add.
Right. And you do the same philosophy around the rest of the world, not just in the US.
Yeah, the same philosophy, right? No difference in terms of theoretically how we approach our investments in the U.S. versus how we approach our equity investments outside the U.S. And even tangential to that, our approach to how we think about investing in the fixed income market is a similar evidence-based approach of using what the data is telling us as a way to position our portfolios to deliver outperformance.
Using 60 plus years of academic research, looking at a century of data. I'll take it.
Yeah, I will too.
How large is DFA now? What are DFA's assets now under management?
Yeah, we're up over right about $750 billion, so about $750 billion assets under management, spread across both financial advisors as well as institutional side, and I split between fixed and equity as well. So a broad based set of strategies and solutions available to clients, and that combines with 40 plus years of history of doing this, and something that we're very proud of and looking forward to continued growth going forward.
Yep. Well, we like working with you guys. It's been a good experience for us and our clients, and we look forward to the future. So, Kevin Green, thank you for joining me today. Have a great week.
Yeah, Alan, appreciate it. And good luck to Auburn this weekend.
Yeah, thanks.